If you put $10,000 on a roulette table and the ball lands on green, you multiplied your money by 35. It feels great, but it doesn't make you a financial genius. Yet, when people open a brokerage account, they often carry that exact same casino mindset into the stock market. They trade with their emotions instead of the math. You will hear stories about someone funneling their entire life savings into a random penny stock and walking away a millionaire. Mathematically, that is identical to picking a lucky color on the roulette wheel. They didn't uncover a secret strategy. They just happened to be standing where lightning struck. Over time, relying on luck or a gut feeling about an explosive tech company catches up with you. You might double your money on Monday, but the temptation to double it again on Tuesday usually leads to losing it all. The historical market is a chaotic, complex system, and trying to predict every swing from your laptop almost always ends poorly. Trading on emotion ensures the house maintains the edge. To survive, you have to completely remove your feelings from the equation and adopt an approach built strictly on probabilities. Seeing those massive losses often pushes people to the opposite extreme. To avoid the stress entirely, they pull their money out of the market, stuff it under a mattress, or leave it in checking to keep their risk at zero. This chart shows how that zero-risk strategy actually performs over time. While your cash balance stays perfectly flat at a 0% return, the red line shows perpetual inflation steadily creeping upward. Inflation quietly makes your money about 2 to 3% less valuable every single year. Look at what happens when we apply that compounding loss to everyday goods. If inflation continues at its normal historical rate, by the year 2077, a standard burrito from Chipotle will cost you $50. It is a mathematical certainty. Hiding your money in cash might feel secure, but it guarantees the slow destruction of your purchasing power. To actually build wealth, you have no choice. You must find a way to take on calculated risk. To navigate out of the cash trap, we need a reliable tool to evaluate where to put our money. That metric is a core mathematical concept called expected return. This visualization represents over 14,000 parallel universes. If an investment has an expected return of 5%, you are not guaranteed 5% every year. Instead, if you simulated making that exact same investment across all these thousands of universes, 5% is simply the average outcome. This lets us clearly define risk. Risk isn't just about losing everything. Risk is the possibility that your actual return will deviate from that expected average. When an investment is highly risky, you see a much wider spread of extreme highs and extreme lows. The foundation of all investing comes down to a simple trade-off. If you want to increase your long-term expected return, you must structurally accept a wider, bumpier spread of risk. Let's test our asset options against this metric. Step 1 is cash. The risk variance is completely zero. A dollar is always a dollar, but the expected return is also zero, meaning it automatically loses to inflation. This chart compares risk against reward. Look at the next step up, bonds. When you buy a bond, you are lending your money to a government or a corporation. That introduces a tiny bit of variance, but in exchange, it bumps your expected return up to a much more protective 4 to 7%. Stepping on to the top rung, we find the entire stock market. The variance here is much wider, meaning the short-term swings will be aggressive, but historically, this gives you the best ratio, delivering an expected return of about 8 to 10% per year. Knowing this, trying to guess which individual company will win is a statistically losing bet. Your best mathematical move is to simply capture the baseline expected return of the entire market. John C. Bogle, the founder of Vanguard, devised a structural solution to capture that exact return effortlessly. He pioneered the low-cost index fund. This block chart shows how an index fund operates inside. It uses a mechanism called market cap weighting. Instead of you blindly picking stocks, the fund takes your money and automatically distributes it proportionally based on the total financial size of every publicly traded company. If you buy a broad index fund like Vanguard's VTI, your dollars are instantly fractured across thousands of businesses. Put in $10,000 and $713 automatically goes to NVIDIA, $612 goes to Apple, and down the ladder, a smaller company like Starbucks gets just $14. You stop betting on which horse is going to cross the finish line first. The index fund simply buys the entire racetrack. This graph of rapid spikes and crashes shows a critical reality. The index funds are not safe, tranquil investments. Holding the total market means you will ride out terrifying recessions and frightening short-term swings. But that proven long-term math is exactly why you should avoid the endless buffet of flashy alternatives. Financial companies will always try to sell you hyper-specific thematic funds, triple leverage trackers, or crypto assets. Those complex products carry higher expense ratios, hidden fees that slowly eat away at your compounding interest. A day trader might get lucky and beat the simple index fund for 1 or 2 years, but stringing together 40 consecutive years of perfect guesses is virtually impossible. The most effective approach is almost entirely hands-off. You buy a few low-cost index funds to cover the domestic and international markets, maybe add some bonds, and then you just leave it alone. The ultimate financial flex is forgetting your brokerage crossword for a decade, doing absolutely nothing, and still outperforming 99% of stressed-out day traders.